What's going on out there? It's February 14th. Happy Valentine's Day. I'm Frank Curzio, it's the Wall Street Unplugged podcast, where I break the headlines and... tell you what's really moving these markets. So was I right or was I right? If you listen to my Super Bowl prediction, which was to mortgage your house and put everything you own on the Chiefs, since I predict the Eagles would win and cover, then you should be sitting very pretty right now. But if you did do that, hopefully you put a nice bet on it. And if you did, you're sitting pretty again. But invite me to your house for dinner and beers when I'm in your neighborhood, and we'll call it even. It's like the ultimate guaranteed bet every single year. Hurts a little bit more because it's my Eagles, and I love the Eagles. But what a Super Bowl. What a Super Bowl, up to the holding call at the end of the game, which ended the Super Bowl with 1:50 left. One of the worst calls I've seen in a championship game. And it's not because I'm an Eagles fan. I'd say the same if it was reversed. And here's why. Because you have people on TV and the guy Bradbury admitted that call and said, yeah, I held him a little bit. I'm a basketball referee, right? I was a licensed referee, high school referee for a while. And every game is called differently. We either call it tight or we let teams play. And we'll call it tight if we have two aggressive teams that are playing and they're pushing people in the back on layups. You know, we'll make that calls, tight calls right away, right? To let the coaches and teams know, hey, you know what? These refs are calling a tight game, so don't do anything stupid. And sometimes, and most of the time, we let teams play, especially if they're physical, right? And they have no intent on intentionally hurting other players. You don't want to foul out the best players on their team because they're playing aggressive, so you let a little bit go, right? If you get hit on the hand, you have to call it, of course, because it affects the shot. But that's how you call it as a referee, okay? Being referee licensed, that's how you do, and you do it across all sports. In this Super Bowl, there were no holding calls. I saw Frank Clark get held. I saw Reddick get held a few times. So early on, the refs were letting them play with the Eagles, with defensive backs. I'm not too sure who it was. They spun the KC wide receiver around on a third down play, when he cut to the middle of the field. And, Mahomes missed the throw, and the refs held their whistle. And I was surprised. I was like, wow, you saw his hand, and he spun him a little bit, right? So they let that go. I'm like, okay, and they let it go. They let it go both ways, which is fine. So you let the teams play the entire game, allowing slight pulls, slight holds, since you hold on almost every play. I mean, you grab the guy's jersey in the front, you see it all the time, but you let it go, right? You don't get too crazy. Yet, on that play, you take out the flag to basically a third-string wide receiver, Smith-Schuster. I mean, he's probably the fourth option on that team. He probably wouldn't have caught that pass even if Bradbury didn't slightly tug his jersey. And you ended the game. You ended one of the best Super Bowls. It would have been awesome for the 100 million plus fans who are not, most of those, 90+%, are not fans of either team. They're just watching the Super Bowl because they love it and they bet it and whatever, and record bets on the Super Bowl. But it would be nice to see Hurts and the Eagles get that ball back and try to score for the tie, win the game, whatever. Maybe he gets intercepted, but that's what you want to see. That's how the game should end. It was sad to end one of the best Super Bowls in recent memory. You might say, why was that the best? And how come last year, the year before, whatever, a couple close ones? It's rare that you see during a game that both fans, both teams, right, the Eagles and the Chiefs, you thought that you were going to lose that game. For the Chiefs, it was halftime. The Eagles went up by 10. It was amazing that they reversed that call. I thought that was interesting. The two biggest calls of the game that was the flag at the end against the Eagles and that call for the pass, right, that Smith caught. I mean, if you're reviewing it for 10 minutes, that means you cannot find an angle, and all of a sudden they come and say, okay, it's incomplete. You reviewed it for 10 minutes, 20 angles, and all of a sudden you just come out. I was very surprised at that. That took 4 points off the table for them, I think, which was fine. But when the Eagles went up by 10, Mahomes sprained his ankle just before half, and I know Chiefs fans were like, oh man, holy cow, this is over. And then for the Eagles, I thought it was over. After Mahomes went off, scored 3 straight TDs in the second half, went up by 8 with 5 minutes to go. You're like, wow, man, holy cow, momentum totally shifted. And for the game to end on that ticky-tack call is an absolute disgrace for the NFL. With that said, congrats to the Chiefs. Mahomes basically tore up the best defense in the league while having no wide receivers. He threw for 182 yards, 3 TDs. One thing, though, please stop saying he did it on one leg. The guy ran a 4.340 in the third quarter, running away from 2 of the fastest defensive linemen in the league for a 15-yard gain. And Mahomes is awesome, MVP, incredible performance. I love the guy, but enough with the ankle. Stop comparing it to, all the people who played injured in the past, the bloody sock, the Knicks, all this stuff. Take it easy. I mean, Again, there's ways to allow that guy to play, and he's perfectly fine, but you're not running full speed down the field in the middle of the third quarter running away from two fast guys. So, good job for Mahomes. Fantastic. The NFL got exactly what they want. They need another Brady. They need another Rodgers. They need all that. I get it. I understand. It just would have been nice to see that game won on the field. On the field. Was it a hold? Yes, it was a hold. Did you call it the whole game? Absolutely not. And you shouldn't have called it at that part. It was just a really, really bad ending to the game. And I'm saying that not as an Eagle fan. I'm saying Chiefs. I talked to Chiefs fans. They said, wow, you can't shut the game off tied with 1:50 left because of a penalty. You want to see the game play out. And I was okay with the Eagles losing. I was okay, interception or whatever at the end of the game or loss of downs, whatever. But to lose that way was pretty sad. On another note, I'm really, really proud to be an Eagles fan. And they made no excuses for the loss. The coaches, no one talked about that at all. My biggest concern was, going into the game, the moment might have been too big for Hurts, and he didn't have the experience. But the guy drove his team downfield, scored a TD, and then ran the ball in for the 2-point conversion with basically two guys on his back to tie the game with under 5 minutes left. And that's a championship drive. That's a drive that he'll remember, that the team will remember, because he did not lose that game for them. He had that one mistake, which is fine. It's not fumble, and that's all right. But holy cow. I mean, I love having this guy as our quarterback now and hopefully for another 10 years. He displayed great character. I don't know if you're Sirianni on that catch with Devontae Adams. And the teams are walking back and forth. And Sirianni raised his hand for the Chiefs to come walking back. And you saw Hurts push his hand down and say, hey, enough of that. Have some respect. And I thought that was really cool, right? I mean, it shows great character. Your coach is the one that should have the respect. And he was like, hey, don't do that, right? So as great as Mahomes played with 180 yards, 3 TDs, Hurts passed for over 300 yards. He ran for over 70 yards. He had 4 TDs. He threw passes in that game that I don't know if there's a lot of quarterbacks, maybe 1 or 2 of them that could throw. There was 3 or 4 passes that had to be perfect by inches, by an inch on each side, and they were. And I thought he outplayed Mahomes. Again, he had that one fumble. If they don't make that BS call, though, say if Hurts drives down for the winning drive, the media, the next couple of days will be talking about if he was a god right now. But again, it's all about who won. The Chiefs won. Mahomes was great. Congrats to them. One last note on this before I really get into a lot of stuff going on with the market, especially inflation. The NFL is a bunch of assholes. Excuse my language. Actually, don't excuse my language, because that's what they are. I can't think of a better word. You had a month to prepare that field for the biggest championship game in the world, and the field was complete garbage. It's been garbage in the past. You knew it was. So you had the outline saying, okay, this field usually sucks. And you had over a month, and it was terrible. The Eagles' place kicker almost broke his leg off the first kickoff. We saw at least 20 different instances of players sliding because of this terrible conditions. The second half was a little bit better because every single player had to change their cleats multiple times to find something that worked on that field. But shame on you at the NFL, the billions and billions, the billions of dollars that you made. All this crap, the messages and all stupid shit that you do. This was horrible. This was horrible, horrible, horrible to have that game like that. It was terrible to have that field not ready to go for one of the biggest events in the world. Anyway, great job to the Chiefs. Congratulations. And congratulations to everyone that listened to me. I hate people that say, hey, I was right. Or I told you so, but I told you so and I was right. And actually I was wrong because that's how I picked the Super Bowl. I break it down. I thought the Eagles totally outplayed them. Their defense was non-existent, but still, I thought they would have a chance at the end to win that game and come back, and I felt like momentum shifted in their favor, that they scored that touchdown, and it was really, really sad that offense didn't get a chance to take that field. With 1:50 left, no timeouts, field goal or tie, touchdown to win, interception, whatever, loss of downs, they lose the game. That's what the whole world wanted to see, and they should have got a chance to see it. It was a bullshit call because you haven't called that the entire game. You either call it tight or you don't call it tight. You don't decide to call something that you didn't call the entire game with 1:50 left and end that game. That was sad. And that's even coming from Chiefs fans, and that would come from me if I was a Chiefs fan, or if it was reversed. If the Eagles won the game like that, I'd be saying the same thing. That's a bullshit call, and the fans deserved a lot better than that. Okay, got that out of the way, as you guys are spending your profits on that call, that bet. But let's get to the markets, which continue to move higher, no matter how negative the news is on inflation and earnings. We start with inflation. A CPI came out today. No big deal. Markets are relatively flat right now as I'm taping this. I'm taping this around 11 o'clock. Expectations called for a 0.4% increase in January, but it came in at 0.5% higher than expected. So annually, inflation is up 6.4% last year, year over year, right? So it's up 6.4% from last year. And it's higher than the 6.2% economists were expecting. So with 6.4%, think about that. Think about that we didn't see 9%, 8%, 7%. And think that inflation was 6.4%. It's going to be crashing right now. But it's better because we're able to use the word disinflation, which people are mistaking that word for deflation. Disinflation. We were having disinflation for about 5 months, 4 or 5 months now. That just means prices are coming down. That's disinflation. That's all it is. It's another way of saying, hey, prices are coming down. And they were. They were 9%, now they're 6.4%. But everyone's harping on this disinflation. Disinflation's great. Now, if you strip out the food and energy called the core CPI, right? Maybe you could, make it look better than it was. You can't. It was also higher than expected. And if you strip out food, energy, and services inflation, which is called the super core CPI, even that was higher than estimates, showing that inflation is 4% higher than last year. I mean, maybe they just strip out every single component of the CPI. This way it stays at zero forever. This way there's no components, right? Maybe you do that. Start stripping out every single. I understand stripping out one component out of 20, now you're stripping out like the super core CPI. I mean, you probably never heard of the super core CPI, but this is a big deal now. Because let's strip out everything that we use, right? Oil, energy, whatever, natural gas, food, services, inflation, everything that we pay for as a consumer. Get rid of all that. That shit doesn't matter. Even though it affects every single, that's the most, right? That hurt the consumers the most. Let's strip all that shit out. Let's just call it the super cost CPI. But you even tried to do that and it still didn't work. Either way you look at it, this was a horrible number. The data I'm seeing in real time for February, this is data that's reported for January. In February, it shows that inflation is starting to rise again. You're looking at rental properties, used cars, gasoline, food. They're starting to rise. So in short, this number, which is surprising since Powell talked about disinflation and mentioned that word a ton over the past few weeks, which everyone's excited about, this number coming out, it indicates two things. It indicates that those expecting for a Fed cut later this year, that's off the table. It also indicates that those expecting just one more rate hike, some thought they were done, some said one more, that's not likely going to happen. The Fed's going to need to get more aggressive since inflation is rising again. Okay, you're seeing it go in the opposite direction again. We're still up tremendously, and what they've done so far has not really made a dent. You could say, well, it made a dent from 9. It was still growing at 6%. Holy cow. How are we not negative after all these rate hikes? But that's the bullish thesis, right? The Fed's going to stop, and they're going to start lowering at the end of this year. That's the only bullish thesis right now. And basically, this number, again, it's 1 month, but remember, the Fed is not going to F around with this. This is the biggest mistake that we've seen in the history of the Fed since it's been created. It's 79, 80, 81. Go back and forth and, lowering rates and raising rates and decide to not raise rates and keep them high long enough was one of the biggest mistakes in Fed policy. And Powell made it very clear he is not going to make that mistake no matter what. He doesn't care if he pushes the markets in the recession, which he's trying to do. I said this from day one. This is when they switched in November. I'm talking November 2001, when he said, oh, it's no longer transitory. The only way to stop this kind of inflation is to force a recession. And we're not seeing that being forced right now. So they're going to be more aggressive. They're not going to stop and say, hey, everything's okay. No way. No way. Because if they do nothing right now, you're going to see inflation go right back up. Now, that's the first thing. The next thing is let's turn to earnings season, which Q4 is basically over. You have more than 80% of the companies reported, including almost all the majors across every industry, right? So most of them reported. And I just wanted to share one stat from you. I've been high on earnings. It's very, very important, and I think it's being overlooked. So if you look at Q4 2020 earnings per share, which is reported, it's forecasted to have contracted 2.2%, right? So this is the current quarter. That's what's around there. It might be off by a tenth, right? Because again, more than 80% reported. This is 100% due to margin weakness, right? So companies are losing pricing power. This decline comes on top of the major cost cutting that these firms announced over the last 3 to 6 months. And now they're getting, recognition, and that's what's driving stocks. So everyone, Facebook, they saw Facebook do it, the stock went up 20%. Now all technology companies are drastically cutting back on CapEx. I can explain why that's a big deal and why you should be concerned, right? So all right, cost cutting, that's what Wall Street wants. Just like Disney, right? They want to see those numbers going higher, even though no one's paying for our services for Disney Plus. That's what Wall Street wants to see. That's what's driving the stock. Believe me. Every CEO knows what drives their stock. It's not always earnings. It's not always sales. Sometimes it's subscribers. It's same store sales. Different things, different metrics. Average revenue per user, different things. Okay, everybody knows. Right now, these companies know, hey, if we drastically cut costs, Wall Street loves that, and our stock's going to go higher. So that's what they're doing. And even though they've done that over the last 3 to 6 months, we're still seeing earnings contract by 2.2%. But here's a stat that's alarming. So since the close of Q4, and that closes December 31st, 2022, right? December 31st every year, earnings per share since then have fallen. These are the estimates, by 1.7%. Now, on average, we usually see earnings rise during this period from January 1st into February by an average of almost 3%. So you usually see them rise by an average of 3%, and we're seeing these estimates being revised lower by 1.7%. That might not sound like a big deal, but it is, considering this is the largest decline we've seen in revisions over this period in 24 years. So you're looking at 98 quarters, outside of a few exemptions, right? The exception, which is the 2001 recession, when tech stocks fell over 70% through 2002, the financial crisis of 2008, when the markets collapsed over 30%, and then really quick in Q1 2020 during the pandemic, and stocks fell again over 30%. It was the only time periods that we saw this part of earnings being revised this much lower. Usually they go up around 3%. They've been revised down 1.7%. Now, let's look at those periods real quick because they're important. So in 2001, 2002, it was a disaster. Tech stocks fell 70% from the March 2000 peak, but started moving up in 2003. Why did they move up in 2003? If you go back, the Fed drastically lowered short-term rates from 6% to 1% through 2002. So the Fed was there to bail out the markets. Let's look at the financial crisis, 2008, 2009. Markets crashed over 30%. But again, the Fed was there to lower rates to zero and actually invest money for the first time directly into banks and financial institutions like Fannie, Freddie, AIG, backstopping all the bad debts and said, don't worry about all the bad debts. We got them. Merge all the banks, make them even bigger. They're supposed to be, avoid too big to fail. Now they're 3x to 5x bigger than they were back then because they took over all the banks that had bad debts and they backed those bad debts. And those bad debts turned out to be very, very good, expected on the mortgage side as the housing market rebounded tremendously since then. But this helped avoid a global catastrophe where everyone was over-leveraged and the market was crashing globally, the financial system globally, right? They did a good job then. Even though you hated it, they had to do something, and they managed to shore up the system and be there for us. And then we had Q1 2020, which was recently. We all remember the pandemic, lockdowns. Nobody models for 80, 90% revenue declines in 3 months, 4 months. No one in the world does that. So, the markets fell sharply, 30%, only from February into March, right? They quickly reversed. Why? Again, we have that beautiful Fed. Save the day. Awesome. Lowering rates to zero, flooding the markets with liquidity, not hundreds of billions, which was like $450 billion during the credit crisis. No. We're going to go like 11 trillion this time. Over 50% of GDP, and that includes 11 trillion fiscal and monetary stimulus. And we saw the markets reverse higher very, very quickly, which makes sense when you throw that much. Doesn't matter if you have revenue, right? Because you're basically giving money directly to businesses, directly to people, right? You're handing them checks directly. You're not doing it through the banks like you did in 2008, 2009, where they decided, okay, we're still going to look at credit and see who we lend and be conservative on this and whatever. No. They just gave it to everybody, and everybody just spent like crazy. And again, we saw this 2020, the market surged in 2020 during the pandemic. It surged. Right? We had the pandemic in 2020, and the market actually took off in 2020. We saw what happened in 2021. The Fed kept the pedal to the floor. Right? So those are those periods. Today, what do we have? Earnings being revised significantly lower. Even worse, we decline, and we will decline by around 2.2% Q4, but projected right now to decline by 4.8% next quarter, which is Q1, and to decline by another 3% in Q3. And by the way, each passing month, these numbers are being revised lower and lower, which is not a good sign. To make matters worse, the Fed was able to bail us out the last 3 times we saw massive earnings revisions and massive year-over-year declines. However, the Fed, during this earnings recession, that's what it is. It's a recession on earnings. You're going to have 2, 3, maybe 4 periods of negative earnings year-over-year. They're not lowering rates or buying bonds in QE, which saved those markets. They're actually still raising rates. They're actually shrinking their balance sheet, which is QT, quantitative tightening. And this is expected to continue at least through the summer, likely into Q3 now this year after this inflation number. This has taken place while inflation is still up 6.4% year over year. And now it's trending in the wrong direction. In the face of this, what do we see? You think the markets will be pulling back sharply? We're not. The most risky stocks, ones that are most heavily shorted, again, it's very easy to see. It's very easy for algorithms to trigger this stuff because when you short it, you run the cover as soon as things go higher and higher. They're up, 15% plus year to date? The Dow S&P also moving sharply higher so far this year. And you may be asking, Frank, why is this happening? Why is this happening now? How come we're not seeing stocks come down? And for me, I think in past bear markets where we saw 30% plus declines, there was always a catalyst that started that, right? You had the 2008 financial crisis, a lot of companies going out of business and just, again, through 2007, the writing was on the wall, Credit Suisse and their funds and everything. Banks leveraged too much. In 2020, we saw the pandemic. This is recently, right? We're like, holy cow. We saw the catalyst, right? This is different. It's like a slow drag, right? You have this tightening process that's continuing. You have credit card rates are surging. Your bills are surging, right? Everything you pay for is going up and up and up. Credit in general is much more expensive. And it's a constant slow drag where net wealth is slowly decaying each passing month. It's going to continue. It's going to crush most people because they're going to be forced to rein in spending. And you're seeing that. You're seeing that right now. As companies, what are they doing? The major companies, they have AI, they have data analytics all over everything. Even Walmart telling their suppliers, look, no more raising prices. And what do they have? Tens of thousands of suppliers and how many customers that they have data analytics on and spending trends and everything. They know everything about every customer. It's one of the largest retailers in the world, not the largest. Big box, at least. Amazon may be larger. But what are we seeing? Now we're seeing companies adjust. They continue to lay off employees regardless of what the unemployment data shows. Just throw that out. We saw the massive revisions. We just continue to see more and more layoffs. They're cutting costs significantly. Why? Because they're seeing spending trends fall sharply. And this cost cutting is eventually going to go into business travel with airlines and hotels. Already started at this year's CES in terms of the booth space and everything, which it was not exciting. I mean, these booths are significantly dialed down. You had a much better showing than last year, of course. Still not peak, but it wasn't fun for the first time in 12 years. By fun, I mean most booths were basic. You'd have robots strolling the floors, drone expos, test driving EVs like I've done in past years. None of that was available this year. It was mostly someone who goes there to test a lot of these products and have fun with it and tell you, you had your people that talk about products, but there was no big displays. I was playing ping pong against robots and stuff like that. All these years of going, testing these devices, running on these treadmills or playing video games. None of that was there this year. They dialed back significantly. At least 30, 40% on those booths. And it makes sense. I mean, you look at remember the massive EV predictions, right? EV is the greatest trend in the world. Okay, these predictions, 65% of all cars are supposed to be EVs by 2030, right? This is from the IEA and other tons of consulting firms. You can go down a list and just 60 to 65%, right? They're saying all cars by 2030 are going to be EVs with 65% of all cars, right? So that's what they were predicting. That was last year they made that prediction. Okay, if you look at how many cars are sold, say an average 70 million cars sold globally each year. Maybe that goes up in 5 years, I don't know. But around 70 million, even pre-pandemic, it was like 71, 72, and I think it was 68 this year, last year. If we're looking at 70 million on average, that amounts to 46 million new cars that are expected to be EVs by 2030. That was the forecast made last year. Today, it's been dialed down just a little. Yes, I'm being sarcastic. So just 1 year later, based on a recent survey of global automotive executives, this is from KPMG, the biggest in the world, it's gone from 65% of all cars that'd be EVs by 2030 to 35%. Which means we no longer expect 46 million new cars sold by 2030 that it's going to be EVs. We're only expecting 35%, which amounts to 26 million. You know how big of a difference that is in 1 year in forecasts? And again, that number is based on a real survey of global automotive executives that are saying, whoa, we have to slow down. They could blame supplies, they could blame whatever it is. It's demand, it's credit for new vehicles, and they're trying to lower prices, even though Ford right now loses money on every EV they sell, but they're lowering prices. Oh, to better compete. Not to better compete, because you have to, because people are not, they're seeing, right? They're seeing the trend. I don't care if you, to compete. If you have a great iPhone, and iPhone's the best phone out there, arguably, they demand a high premium. They're not cutting costs because Samsung lowered their costs because they have a better product. You don't lower costs to better compete. You lower costs because you're not seeing demand at that current price, right? You want to price it as high as you can of what customers, obviously customers, if they were paying for it, Ford would not be lowering prices. GM would not be lowering prices on EV. You wouldn't see Tesla lowering price on EV. They say this because they're seeing demand come down. It's a different market. But now let's throw in all the major growth trends here. Let's go with forecasting cloud, data analytics, stuff I talk about all the time, CapEx spending, huge. Whether it's, trends like AI, EVs, right? I just mentioned all these forecasts have come out in past years for 2025, 2030, 2040. They were based on earnings growing at 8% annually and interest rates staying at historically low levels, and the Fed constantly in QE mode. Think about that for a minute. I mean, these numbers are going to come down dramatically in the months and quarters ahead. We'll see what EV is going to see across all these trends. Why? Because instead of earnings growing at 8% annually, they're likely going to decline 20 to 25% from their peak. That's why we've seen the major companies with the largest balance sheets are significantly reining in their costs. They're not being aggressive in acquiring companies. They're reining in costs. They keep saying it even during this earnings season. Microsoft. You look at Amazon. You look at Facebook cutting costs, right? Oh, well, Facebook's doing it. The stock went up. That's what we want to see. The quarter wasn't that good. The numbers weren't that good. So, more users. Okay, fine. But to go up 20%? Like in a day? You know how much that is? And a market cap that is? Holy cow. For a company that size to go up that much? Why? Because that's what Wall Street wanted to see. Now you're seeing everybody cut costs. And they are, because everybody's cutting back on CapEx, on advertising, on everything. Advertising is usually a percentage of sales. If your sales are declining, which you're seeing across the board, they're coming down, growing a little bit. But again, even as a percentage of earnings or cash flow, you're seeing those numbers come down. So you're going to see advertising budgets shrink. And you're seeing that across cable companies. They're all talking about it. Not advertising as much, not spending as much. And you're looking at a trend, guys, that's just beginning. We're in the early innings. And we're starting to see second rounds of layoffs from large companies. We talked about the best way to protect yourself is buying long-dated puts, which they may be out of the money for a little bit, for a couple of months. Big deal. But you're looking 3 months from now, 6 months from now, we'll likely see the markets pull back significantly. And that's just from the things I mentioned, like Fed tightening, higher than expected inflation. Expecting to come down much more, and it's not. It's reversing. Also, this massive decline in earnings, but that's just from that picture. I'm not talking about geopolitical risks like Russia. I mean, would he bomb the pipeline? I don't know. There's Navy SEALs that is saying it. Is it whatever you believe or not? I just know that blaming Russia is hilarious that they bombed their own pipeline. It's like Elon Musk bombing all of his Tesla plants to better compete with Ford and GM. Like, something happened there, but I can tell you, Russia probably thinks that we did it. Not to mention, we're supplying Russia's enemy with weapons. And that's like getting into a one-on-one fight with someone and some guy next to him hands him a bat and he beats the shit out of you with it. I mean, I don't know about you, but when I get my revenge, it's going to be on the person who beat the crap out of me with the bat and also the person who handed him the bat. Isn't that the same thing? That's what we're doing. To a nuclear power where the president of Ukraine is doing everything he can to start a global nuclear war. I mean, how many times has that guy said, well, our nuclear plants are getting attacked, they could leak? I mean, we heard that story about 10 times, right? Doing everything he can. But our ties with Russia are bad. And look at China. I mean, tensions have never been greater between the U.S. and China right now. It's horrible. The balloon, whatever. It's just policies and tariffs and whatever. I mean, it hasn't been good. We're not on very good terms with them right now. But I'm not even talking about those risks. Those are additional risks that would normally push down the market or scare people and say, hey, we need to position ourselves a little bit just in case. Now, stocks will continue going up for months. It's common in a bear market to see moves like this. But eventually, stocks and the economy are driven by earnings and spending. All right? That's factual. And both are declining at a pace that we haven't seen since 2001, 2008, and recently in 2020 during a pandemic. We've never seen these types of declines since then. And we know what happened since then. We also know that the Fed was there to bail us out, provide support. They're not going to be there this time. That should scare the hell out of you in terms of risk management and not protecting yourself and being 100% long in this market. And people say, well, you just need to hold stocks long term. You'll be fine. You have an opportunity where if stocks do crash and come down significantly, you're going to be sitting there with a huge cash pile. Not only that, making money off of your puts, not just protecting yourself, making money. But you just learn as much as you can about buying long-dated puts. You can learn by going to, we have an offer, www.mftoffer.com, which we talked about. We lowered the price of that newsletter significantly. You could Google it, learn how to protect yourself, learn how to trade these things. They're very, very easy. But it's not just protect yourself, it's how you can also make an absolute killing if the market does fall significantly over the next year, not the next month. You're not short the market. You're only going to lose as much as you put in, which should be maybe 5% of your total portfolio. We explain this in our portfolios. We explain this in our videos that we do, which could take 30 to 40 minutes. And I'm sorry, you got to watch my ugly face for 30, 40 minutes, but that's what paid people get. You get to see me. You don't get to see someone else writing shit or doing anything. This is how we've managed the portfolios. I got to tell you, as we showed with our portfolios, we did not risk much in returns by using this strategy. Portfolios did incredibly well to start the year. Most of them outperformed the markets, even though we protected ourselves. So it's worth it to learn this strategy. Again, it's nothing for me. It's something for you. If you want to protect your wealth, if you want to make money, again, this is something that in the face of right now in a market, this craziness, we have stocks ramping higher in the face of lower earnings. They constantly be revised lower and lower and lower. Higher inflation now? Are you kidding me? Inflation reversed now? What happened to the disinflation that he was talking about, which is just inflation going lower, right? We're not talking about deflation, talking about disinflation, which the definition is inflation going lower. You just, that word, I guess, sparks excitement because it's mentioned everywhere now. But again, this is in the face of much lower earnings, high inflation, higher rates, and no Fed help. Continue to reduce his balance sheet, reducing liquidity from the market. I mean, if that's not enough to worry you, did you see what the 6-month Treasury is trading? It's over 5% the yield. That's the highest level in 15 years, I believe. I mean, the last 2 times it was over 5%. The 6-month. I'm not talking about 3-year, 2-year, whatever. Not talking about the 5-year, 30. I'm talking about the 6-month Treasury is over 5%. The last 2 times it was over this level, 5%. It was in 2000, just before the market crashed, and 2007. And you know what happened after that? All I'm saying is be careful out there. I could be wrong. I'm not telling you to sell all your stocks and run to the hills. That's not the message I'm telling you. I'm telling you that you need to protect yourself because shit's happening that hasn't happened in the history of the markets, and especially in the 30 years that I covered it. And I hate being bearish because I'm the most optimistic person you'll ever freaking meet. But you have to be smart with this. Try to ride the trend. You should be long in our portfolios. Yes, we covered 5%, and we're down on that part of our portfolio for now. But these are long dated. That's why it's important. With Money Flow Trader, how to do this. Jenny tells you exactly how to do it. You can do it right from your portfolio. It's very quick to set up. It's not like this whole learning curve. You just got to do what she says. It's very easy. That's why we lowered the price to help you guys, try to protect you guys, because it is going to be a nasty year. You might not see that now, but the writings on the wall, when we saw markets like this, earnings revision, stocks going higher, it only happened during the most severe market corrections and market crashes that we've ever seen. And that trend, again, that pattern is happening again. You want to bet against it? Good luck. Go 100% long, and that's cool. But it doesn't hurt to protect yourself. And not only by protecting yourself, if you're right and this market crashes, that 5% of your portfolio you're protecting yourself could be worth 30, 40, 50% of your entire portfolio because you make an absolute fortune if the market really comes down sharply over the next 3, 6, 9 months. That's how you play these markets, especially with this kind of uncertainty. So guys, that's it for me. Wanted to wish my mom a happy 80th birthday. This is like a tough stretch for me these days because my daughter's birthday, my oldest daughter is February 12th. My mom's is the 13th. And then we have Valentine's Day today, which is the 14th. So, my wife and my 2 girls, 3 girls there. My mom, she just called 1-800-FLOWERS and put on auto renew every year for flowers and flowers and flowers. just spent $300, $400 worth of flowers for my girls and my mom, but all great stuff. So happy Valentine's Day. Last thing here too, guys, we are launching a brand new product called Wall Street Unplugged Premium. And it's going to start probably in 2 weeks. So all these podcasts that we do, and Daniel and I and podcasts and stuff like that, is going to be behind a paywall going forward. There's just going to be one free podcast. It's going to be about 30 minutes. It's going to be me and my monologue. And it's not going to be as detailed as I was today in terms of how to position yourself, how to make money in this market. We're going to be talking about general trends in the market, at least during that. But we are going to be offering special recommendations every single week from a trading perspective and a trading newsletter. You're going to see special documentary type things where I'm going to be traveling to different areas and showing you different companies, and that's going to be behind this. So it's going to be for a very little amount every month, but a lot of the stuff that we were offering free that you guys see has incredible value, we are going to put it behind a paywall because, we do notice that, especially when I listen to podcasts, the value is absolutely incredible. Some people who do have paid podcasts are charging a fortune for it. We're not going to do that. It's going to be for a very low price, less than what you pay for a cup of coffee, probably 2 cups of coffee right, for the entire month. But everything that we do and all the value that we create, a lot of this stuff is going to be behind that paywall now. And it's going to be just the special community, this group, lots of live stuff, live videos, live portfolio updates and video updates and things like that we're going to provide for you guys. So transitioning into that has really, really excited. And you're going to see that change come in about 2 weeks. I'm going to talk more about it and more of the things that you're going to get, which is a ton. Through Wall Street Unplugged Premium, which we're really excited about. Again, it's going to include a newsletter, which is Dollar Stock Club. You're going to have a pick every single week, though, through this, which Dan and I are going to break down that pick, and then that's going to go into the newsletter. We're going to have bull and bear debates on stocks, talk about different recommendations, really dig in. We're going to have tons and tons of ideas now, but that's going to be behind the paywall. And we're really, really excited about it. So we'll talk to you more about it over the next couple of days, but in about 2 weeks, you expect that. And then we'll just have one free podcast, which I will be doing. That's going to be a monologue, probably for about 30 minutes, 20 minutes or so every week. But everything else, a lot of the interviews, not all interviews, but a lot of interviews are also going to be behind that paywall, and much, much more ideas, which would be really worth it for anyone that wants ideas, wants really good research, and wants research from someone that's been doing this for a very, very long time, that gives a shit about their customers. Because I know a lot of people out there don't. You guys know that we do. So really excited to launch that product. You'll see it in a couple of weeks. Again, happy Valentine's Day for everyone out there. I'll see you guys tomorrow. Take care.